If every country is in debt, who, exactly, are they all paying back? Turn on the news in almost any country on earth, and you'll hear the same warning.
The national debt is rising.
The government is borrowing too much. So here's the mystery. If almost everyone owes money, then who is on the other side of the ledger? The United States is in debt. Japan is in debt. France, Italy, the United Kingdom, all in debt. So who is the creditor when the borrowers include nearly the entire world? Is there some hidden global super creditor? Or is the answer even stranger than that? When people first ask this question, they usually imagine debt, like household debt. You borrow from someone else. You owe them. Simple. But countries don't work like households. And sovereign debt is one of the most misunderstood forces shaping the modern world. A country is a web of institutions. The government borrows. Banks buy government bonds. Pension funds hold sovereign debt as safe assets. Foreign governments hold it in reserves. And sometimes central banks buy it back with newly created money. So when a government owes money, it often owes its own people, directly or indirectly. But this wasn't always how the world worked. There was a time when borrowing was personal, unstable, and dangerous. A king might borrow from wealthy merchants to fund a war, but there was always a problem. Why trust the king? Lending to rulers was risky, so loans were expensive and limited. The breakthrough came when some states developed something revolutionary: credible public debt. Investors no longer lent to a person. They lent to an institution expected to outlast any one ruler. England after 1688 is the classic example. In 1694, the Bank of England was founded. This established a powerful model. A government could issue debt. Private investors could buy it. A central institution could support the system. And the credibility of the state, backed by taxation, made borrowing sustainable. That changed everything, because a government that can borrow reliably can outfight a government that cannot. Public credit became a weapon. Government bonds became attractive assets. Not exciting, but dependable. Who was the creditor? At first, mainly wealthy investors and institutions. But as systems matured, more people became tied to state debt. Government bonds became not just a way for states to borrow, but a way for societies to store wealth. For the bondholder, it was an asset. One person's government liability became another person's retirement security. As centuries passed, debt markets deepened. Governments borrowed to finance wars, railroads, industrialization, and social programs. And banks discovered that government debt was especially useful because sovereign bonds were treated as safe, liquid collateral. Then came 1971. The United States ended the dollar's convertibility into gold. The world moved into a fiat money era. And that changed sovereign debt again. Governments issuing debt in their own currency were no longer constrained by gold. Central banks could create money. Bond markets could expand much further. This is the second major answer. Who's the creditor in a fiat system? Sometimes private savers, sometimes institutions, sometimes foreigners, and sometimes the central bank itself. Debt systems do not usually fail the moment debt gets large. They fail when confidence weakens. The key variable is not just debt size, it's the structure of the debt, who holds it, and what currency it's issued in, and whether people believe the system is manageable. If a country borrows in a currency it cannot print, often dollars or euros, it is vulnerable. This is why emerging market debt crises can be so violent. Easy global money, heavy borrowing, then a shock. And suddenly yesterday's manageable debt becomes today's national emergency. Then there's another dangerous pattern. The sovereign bank doom loop. Banks hold government bonds because they're treated as safe. But if the government's credit becomes suspect, the value of those bonds falls. Banks weaken. And if banks weaken, the government may need to rescue them. That worsens the government's fiscal position, which further weakens the bonds. This loop was brutally exposed in the Eurozone crisis. Greece, Italy, Spain, Portugal, all faced versions of the same trap. Once sovereign debt is woven through the banking system, a debt crisis becomes a crisis of savings, pensions, and political legitimacy. That's when debt stops being an accounting topic and becomes a social one. Whenever debt crises hit, people ask who will pay. Sometimes creditors take losses. Sometimes taxpayers pay through austerity. Sometimes savers pay through inflation. Sometimes all of them pay. This is why sovereign debt politics becomes so bitter. The 2008 financial crisis began in private finance. But when the private system cracked, government stepped in. They bailed out banks, stimulated economies. Private debt problems became public debt problems. When private credit booms collapse, the state becomes the shock absorber. Then came the pandemic. Governments spent on a massive scale. Central banks bought more debt. Deficits exploded. Then inflation returned. Central banks had to raise rates. Bond prices fell. Interest costs rose. Governments that had grown comfortable refinancing cheaply faced a harsher world. Global debt has reached levels that would have seemed astonishing decades ago. And who's the creditor now? Domestic households through pensions and savings. Banks, foreign governments, central banks. So if every country is in debt, who's the creditor? The answer is not one entity. It's a system. First, their own citizens indirectly through pensions, insurance, and savings. Second, domestic financial institutions that hold sovereign bonds as core assets. Third, foreign investors and governments through trade surpluses and reserves. Fourth, central banks that purchase government debt. But the deepest answer is this: the creditor is the monetary financial system itself. Government debt is not just a loan. It stores savings, collateralizes markets, and supports bank balance sheets. So what should you take away from all this? Takeaway number one: government debt is not like household debt. A household cannot tax. A household cannot issue currency. A sovereign state operates under very different constraints. Takeaway number two: the creditor is often the same society the government serves. Paying down debt isn't simply getting rid of what we owe. It can also mean removing assets from the private sector. Debt is not just burden. It is also infrastructure. Takeaway number three: the real danger is not debt alone. It is broken confidence. A country can carry high debt if investors trust the system. But when confidence cracks, everything changes quickly. Interest rates jump, banks weaken, and the quiet assumption holding the system together suddenly disappears. And that leads to the warning. The next debt crisis may not begin where people expect. It may begin in a place assumed to be safe. A bond market seizure, a banking problem caused by losses on sovereign securities, a slow erosion of confidence. Because modern debt crises are no longer just about, can the government pay? They're about, can the system absorb what happens if people stop treating this debt as safe? So if every country is in debt, maybe the most important question is this: what happens when the creditors realize they're all exposed to each other? If you want more deep dives into money, power, and the hidden mechanics of the world economy, subscribe to Financial Americana.
Because the biggest forces shaping your future are often the ones hiding in plain sight.